Hello everybody, and welcome to this next video episode from the RICS Tech Partner Program. I'm Andrew Knight. I've been with RICS for over 10 years now, and I currently lead the program to look at the effect of data and technology right across the built environment. RICS members work globally across all the different asset types and across the full life cycle of property. So our members are working in residential, commercial real estate, alternative assets, infrastructure, and clearly data and technology has a huge impact on the way the profession's working and the way that other stakeholders can access data and use technology to improve the performance of real estate assets. Before I looked at this area of data and technology, I also led our engagement with the capital markets, focused on the City of London, given the importance of valuation, particularly to the sector in terms of the financial reporting, lending, etc., particularly around commercial real estate. So this is a really interesting topic this morning. I'm going to be talking to Matthew Hopkinson from Income Analytics. So Matthew, please join me.
Hi, Andrew.
Morning, Matthew. Hope you're well. It's always great, I think, whilst we talk about data and technology, to almost kind of talk about the people side of things. And I'm always intrigued to understand the kind of background, the backstory to a prop tech firm and the mix of skills and experience that you and the team bring. So I'd love to hear a bit of a backstory from you and paint a picture of the team at Income Analytics.
Yes, sure. Well, there are three sort of co-founders in the team. I hasten to add the other two, the brains. So my background, I was in the military for a while, and I left there and I joined Focus Property Intelligence, which some people remember from the old days, the company which was founded by Michael Nicholson. And then I worked, we were acquired by CoStar, so I worked with CoStar for 5 years, and then went off to help set up the local data company, which is a sort of retail data analytics company. And I did that for 9 years. So my background really is around data in the truest sense. But you know, people and data and creating solutions is key. And actually, I think the commercial real estate market is really ripe for that. It doesn't, compared to other sectors, shine as bright as it could do on that front. So the other two, the brains behind it, so Matt Richardson, who was previously at Fidelity and helped set up their real assets business there, and before that he worked at IPD and he worked in Asia and stuff. So he's got a very broad experience, over 30 years in that space. And then the sort of the maths man is Chris Arnold, who's head of quants at Fidelity, who's very bright, and he's helped sort of create the model, and he worked with Matt at Fidelity for those 11 years as well. So pretty broad experience. And then our chair is a guy called Max James, who was head of lending at HSBC, and then he was CEO of Quintain. So quite a sort of broad spread, but everyone with 20+ years of experience in commercial real estate. So we understand the sort of the issues, and hence why we've created what we think is quite an innovative solution.
Well, that's great to hear, and it's become a bit of a cliche on a lot of the conversations I've had with the partners, that mix of experience is really key. That if you just have people who, dare I say it, are technically very qualified, unless you have that knowledge of the idiosyncrasies and the kind of the backstory in this case commercial real estate, there's a danger that people build technical solutions that arguably are kind of a solution looking from a problem. So I think it's really key that we have that mix of experience when we're trying to solve some of the problems that real estate has. And as you say, at the risk of being slightly kind of pejorative about the sector, it's not the most advanced in terms of its use of data, in terms of the availability of data and being able to share data. So on that theme, I suppose it's an obvious comment to say, but what's the problem you're solving? What are you setting out to do and make better, Matthew?
So I think essentially the question that we're setting out to answer is very straightforward, which is, what is the percentage probability that a tenant will go default during the term of its lease? And why that's so important is that people have quite often hung up about capital values. But actually, when you look at the income return, in terms of the UK, and you look at the MSCI data, long-term returns over 70% is from the income element. And when you actually look at the volatility of capital versus income, income is 8 times less volatile than the capital. So you've got this sort of key element of saying, well, how do we quantify the income? Because obviously the quality and duration of the income will ultimately determine the value of the asset. And whether it's valuation or anything else, you've got to really have an understanding about the changes in that quality and duration of the income. So that's what we simply set out to answer.
And is it slightly rude to the sector to say that historically that's been done in a slightly kind of one-dimensional way of, I know, getting a D&B rating and just looking at a covenant strength as the only dimension you've got? Is that a fair assessment of what the market's been doing?
It is. I think the market's primarily been driven by credit reports, but credit reports will not answer that question of what's the percentage probability of default. You need a quantitative measure, which is what we've created. So you can't have something saying BA3, you can't have, say, strong covenant, undoubted covenant, because actually what you need to do is actually apply those into cash flow models and forecasting, and therefore you actually need quantitative measures to understand that. The other thing that
carry on, Matthew. Yeah.
No, I was going to say the other thing that comes into play is that the sort of credit reports are very, nationally driven. So I cannot compare a UK company to a US company to a German company. So we need some way to have some kind of global measure of risk. And then the sort of third piece, which is really key as well, is I need to be able to relate that income to other asset classes. So we've created this equivalent sort of corporate bond rating. And then finally, and probably the most important piece, is looking at credit reports is always backward looking. And there's always this aspect of, well, the accounts are 18 months out of date. And ultimately, you're wanting to look at the forward projected risk on your portfolio of likelihood of tenants defaulting, and then be able to fix that in, weighted by the income, as to what your exposure is potentially to that default, to that tenant, or that group of tenants. So those are the really key, new, unique things that we've brought to the market.
So in nuts and bolts terms, what kind of data sources, what kind of algorithms, what are you doing to achieve that, as you say, that wonderfully elegant kind of bond rating type classification, to move away from just, as you say, hard to compare credit ratings and those backward looking, one-dimensional data points? What have you actually done in terms of sources of data and approaches?
So for quite a bit of time, we've spoke to a number of the sort of credit reference agencies, because obviously we ultimately sit between the actual sort of bond rating guys and the credit reference agencies. And most companies don't have a sort of bond rating. So it's quite key that this solution is available. And we spoke around the market, and we ultimately decided to go with Dun & Bradstreet. And one of the reasons is that the comprehensive coverage they've got and the DUNS number, because understanding your counterparty risk in a portfolio is really key. And obviously they've got a good representation in commercial real estate as well. So what we do is we've take the data, and the bit that we're interested in is in the 1-year probability of default that lies in the data, not the credit rating, but the probability of default. And then what we do is we take that and we apply it into a universe of 420 million companies to give us this percentile of where a company anywhere in the world lies on that sort of percentile rating. The second thing that we then do is we take that probability of default and say that if we were to go to the bond market today, what paper would that buy us in the bond market? So you create that equivalent bond rating. And then thirdly, and this is where the technology and the power of data and technology, this wouldn't have been possible 3 or 4 years ago. Sheer, trillions of rows of data, is we've gone back to January 2007 and looked at all the actual outcomes in order to provide a projective cumulative probability default out for 10 years. And if you just look at the UK alone, that's over 14.4 million companies where we're taking a snapshot every day since January 2007. So there's a lot of data that's going into the model. And the key thing is, and when people say, is it back tested? Well, the back testing is in the actual outcomes of the data. It's not modeling, it's based on actual outcomes.
Exactly. No, I mean, I worked back in the noughties with a firm that was doing regression analysis on consumer
And we ultimately decided
volume of big data. And as you say, our back test was real transactional events. It was real activity that drove it. So what does your platform allow customers to do? Because clearly they'll be thinking about individual assets, about portfolios, and I guess they're also going to be thinking about that dimension of time, about looking at trends in terms of whether assets and portfolios are moving. So from a client perspective, what can they actually see and do?
Well, absolutely. So what I'll do is let me sort of share my
Yeah,
screen and show you what we can see. So hopefully you can see my
I can
screen.
indeed. Yeah, great.
So what we've got here is we've got this this dashboard, and at the top here you'll see tenant, asset, and portfolio. And this tool enables you to perform two core functions. One is around due diligence at a tenant and asset level, which you can do out there on your own discreetly. And the second bit, which is really the primary thing, is all about portfolio monitoring. So what you see here is a whole load of tenants which are sitting in my dashboard now. And if I wanted to look up a particular tenant, so we've got in here Superdrug, I search, I've got 420 million companies, remember, that I can look at across the world. It will go away and it'll pull up all the companies in the UK called Superdrug. The other thing is it tells me, has your company already bought this? So people don't have to pay for the data twice. So if your company's already bought it, you don't, you get 12 months access, and it says it's in my portfolio. We then go into what is the absolute foundation of everything that we do and what I was just explaining there. So here we have the company Superdrug, and what you can see here are those three key things. So we've got this 1 year probability default here at 0.16%, and we take that, we apply it into that global universe of 420 million companies, and it tells me that Superdrug Stores PLC is in the 90th percentile of all companies in the world relative to its risk profile. And basically 100 is Bank of Switzerland and 1 is insolvent Chapter 11.
Yeah.
The second thing we do is we've taken that to the, the bond market to create an equivalent bond rating, which is BBB plus, and then we've got this 10-year cumulative projected probability of default. Now, we've got other data that comes into play here from Dun & Bradstreet, such as the payment data, and I can talk a bit more about that later. But also, when you buy a company report, you get 2 years of historical data at a monthly level, which is these dotted lines, and then once you've purchased it, it's daily. So it's sort of as good as live to market reporting as you get.
Yeah.
So you've got all of that, and you've got I mentioned about counterparty risk. This is really key because this is part of a massive company, as you'll see here. So here are all the subsidiaries of the parent, and I have to go all the way down here to see this is the company on my lease. So again, do you want that company on your lease? Do you want a parent or do you want a guarantor? And so that is there's lots of other information and accounts that go there that comes into there. But ultimately, the key thing that comes up is that if we come to an asset, so in this asset, you'll see that we've got Superdrug sitting here. All these other companies have been analysed in the same way. And what it does then is it rolls up to give me an asset score. And there are two interesting things that come into play now, which is the real value. Is one, I can tranche the income by that equivalent bond rating.
Yeah.
And two, I can look at my distributions by that counterparty risk, looking at the global parent, nationality, industry, and sector. And you've sort of got that sort of information, which is key. And then you see exactly what you saw before. And the monitoring, this point about being live to market, again, is key, is we're constantly analysing. There's about 385 million updates a day that come in from Dun & Bradstreet, and we're tracking it the whole time. And we're able to sort and alert people to these changes. So that's the sort of the tenant and the asset, and then you can roll up to portfolios in the same way as you can see here. And there's various analysis around the total leases, where the buildings are, the rental breakdown. But I won't, there's lots more to show, but I won't.
Yeah.
I won't bore on. But it is basically wholly unique in terms of that transparency in the data and the ability to create these quantitative measures of risk at the tenant, the assets, the fund, the portfolio and holdings level.
And arguably, it's quite a step change in terms of looking at real estate assets as if they were effectively a bond mechanism with all those kind of metrics that you'd expect the capital markets to produce for that kind of thing. And then you look at that, as you say, that ability to tranche the different levels of quality of income as well. It's quite a step change, I guess, and perhaps some traditional real estate players wouldn't be used to that concept of view of assets and portfolios in that way.
Yeah, absolutely. And I think that one of the interesting bits is we've sort of got feedback from clients, because we're very keen to develop and evolve it. And I think the experience and the networks that we've all built up over the years has made that probably easier than most, in terms of the connection to the market and the practical knowledge of it. And I think that what people find useful here is that someone said to me the other day, it's a bit of a Google Translate, because when they're speaking to investors and others, they can talk about this quality of the income and they can compare it to an equivalent bond rating. And that really helps people raise capital, but also inform investors. And the way that we're in a sort of slightly low growth economy, and was low inflation, but obviously that's changing at the moment, it becomes really important, because there are a lot of people looking to invest in real estate now, but they need the data and they need the reassurance of what they're investing in. And obviously COVID has really set the cat among the pigeons with, who are the winners, who are the losers, how strong is this company, how's it been impacted? And when you've got several hundred or thousands of these tenants around the world, you do really need.
Yeah, great.
So this, and in a way, it's probably the best insurance policy you can buy in terms of monitoring that risk.
And I suppose, as you know, even pre-COVID, there was this move to shorter leases, much more active asset management, where the performance of an asset was even more closely tied to the performance of the tenant. The 25-year full repairing triple net lease in the States. We've moved away from that sort of almost rent and forget model, where actually it's life or death now in terms of how well the tenants perform, really, because otherwise you'll end up with voids or you won't get that performance. So it's kind of an obvious question in some respects, but what range of kind of participants are already using the platform? Because obviously I can see a whole bunch of people that would want to use it, but where are you seeing most sort of take up by sort of categories of clients?
Yeah, so I think that we've got some of the agents using it, particularly in valuation, property management. It's become quite a key reporting tool, and it's feeding in to those valuation systems. And I think your point earlier is really well made, because actually a lot of real estate is becoming more operational, and you've got a vested interest in the business and turnover leases and other things. So it becomes really important that you've got this ability to monitor it. The other people who have been big on it are the REITs, again, because it enables them to demonstrate the quality of the income. And then we've got a number of and what you can institutional investors, some private investors, real spread from whether it's Hong Kong or Europe or the UK. And a lot of people, it's not about the big companies, Microsoft's a good bet. It's actually about the tail. It's the 80% that you don't track that's going to kill you, not the 20% which is up there and already has a bond rating. And I think that people have found that very, very useful, to have a guide from a small partnership or limited company all the way through, and this global exposure of thinking, wow, I didn't know that company was part of this larger group, or actually this company looks weak, I need to have a guarantor, and I can see in the family tree that's the one to go for. So I think it's been very helpful. And the next sort of group, so we've got the investors, the property professionals that we're now speaking to, the lenders, because clearly if they're lending on a whole load of assets, they're wanting to understand how that risk profile is changing, because if the tenants are more likely to default, then their client is less likely to be able to service that loan. So I think that's the next stage we're at now.
Yeah, it's interesting, isn't it? Because you mentioned, once again, pre-COVID, this whole move towards returns mean more income driven rather than capital driven. And you could argue to some extent it's circular to the extent that you only get capital growth if you've got good conditions that are driving good rental income. So it always tends to come back to that income piece. And I guess it's a slight truism to say that perhaps lenders and other parties have been so focused on the kind of loan to value. And I know there's obviously clearly other financial covenants you can use, but once again, from the covenant side, it's becoming so income focused, isn't it? Rather than, dare I say it, thinking that some initial LTV might give you a full sense of security when you're actually lending, in terms of, extending debt to real estate. So I guess that's another area. I mean, have there been some areas where you've almost been pleasantly surprised about how clients are using it in terms of almost kind of things that you perhaps didn't think about, dare I say it, that they're actually using it for?
Yeah, I mean, I think the interesting one has become a couple of clients in terms of suppliers, into a business, or whether you've got people who've got contractors or subcontractors, of understanding that. So there's an element of, in construction and development that has been quite interesting. And actually, we wouldn't have necessarily guessed that valuation teams would have taken it up so quickly as well, because I say we've all been conditioned by capital values. But actually the reality is about the income. And I think that when you look at a sort of a tool like this, and Matt Richardson has a great sort of quote of when he was sort of setting up the real assets piece at Fidelity, is that the head of compliance came in and said, well, on a Friday, we settle our positions at 4 o'clock. And for real estate, you need to do the same. It's like, well, crikey, how do I know what my exposure is? I've got a spreadsheet. Is it spelt correct? Is it to Marks and Spencer? Trading Limited, Marks and Spencer Distribution as a PLC. So having this ability to, at a click of a mouse, to very quickly see what those exposures are and how they're changing and trending, I think is really key. And this is what I suppose data and technology combined together in an easy to use interface enables the property market to really get back up with finance and insurance who've been doing this for many years.
Exactly, as you say, it is unfortunate that we kind of do lag behind as a sector in terms of just the maturity of looking at data in a way that provides this kind of support. And like you, I was very impressed by that kind of who owns whom structure, because clearly people have been caught out in the past by thinking they had a AAA occupier when actually there wasn't really, the covenant didn't go up to the holding company, and you suddenly discovered that the local subsidiary, you're on your own, and that really you weren't part of a very high covenant strength. So that's really important, that the devil in the detail piece about understanding where you sit in those corporate structures, which have, as you know, can be very complex. So I mean, we've kind of alluded it to some extent, but what other factors do you think as the pandemic had on commercial real estate, and clearly how you can then support it? I mean, we've talked about active asset management, more focus on income, but have you seen some other drivers that are, once again, driving the power of what you're doing?
Yeah, I think this the sort of globalization of real estate and the be it investors and operators, and that's become quite key. It is a massive sector in that regard. And I think that when you look at the sort of the amount of investment that comes in from abroad into the UK, and what is going on in the States and in Asia and stuff, I think having this ability to have a global view becomes, absolutely key. I think other bits that come into play, that obviously we weight it by the rent, and when you look at the variance between rent and ERVs as to how that plays towards with asset management. And when you look at, say, retail, this whole idea of people saying, well, retail's dead as a sector, it's like, well, not at all. I mean, you just have to look at Next and other people's results. So the question is, there's a real broad spectrum of performance here at the corporate level, which you might be exposed to. And the question is, where is it? Where's it come from and where's it going? Because you need to have your finger on that pulse. And if you're coming up to lease renewals, or trying to do some form of compliance or financial modeling on the risk, then I really think having a quants-driven model, which is live to market, which is what we've sort of created here at Income Analytics, really is an absolute minimum requirement in terms of reporting to investors, and therefore giving them the sort of certainty and assurance that actually you've got your finger on the pulse as best as you possibly can. It won't, of course, deal with fraud and Wirecard and behavioral economics, such as where some of the CVA scenarios, but actually in the vast majority of cases, it's a very, very good indicator to your risk profile.
Indeed. And I suppose at a kind of a macro level, given that I think normally fund managers look to have a kind of a 10% exposure in their portfolio to real estate, don't they? So it's never going to be, a dominant part of a fund manager's portfolio. But by presenting the information in this much more kind of capital market friendly way, it hopefully makes real estate easier to include in portfolios, and when you're looking at portfolio design and performance and risk-weighted returns, it must make it easier for people to look at a real estate portfolio as part of that overall fund and be able to manage their exposure and obviously, you know, the returns in a way that perhaps real estate has been a bit of an outlier in terms of the tools available for it.
Yeah, absolutely. And I think that this whole idea of you know, multi-asset investment strategies is key. So you know, we were looking at Superdrug just there, and the fact it's up to Hutchinson as a sort of global parent. Now, it might be that you have an exposure in equities and in the bond market and in real estate, but the question is, you won't know that unless you've got some form of integrated data. And I think that the way that we're able to do this, and this is why the quality of the data is absolutely key, rather than someone saying, well, we've let that to Next. Well, the question is, which entity at Next have you actually let it to? And how does that relate to our exposure in the bond market or an equity position? And I think that that is where it becomes really, really key, that you're able to, for the first time, I'd say, create a joined up view of your exposure across multiple asset classes.
Yeah. And I suppose back to sort of pandemic effect, certainly something I've picked up from a number of conversations is the kind of flight to quality aspect, where whether it's retail, I think it was happening in retail before, but now with office, there's an increasing polarization of the quality of assets that people are looking to include in their portfolio. And I guess once again, it's having that visibility of, well, how do we define quality now? You know, because it probably is going to be the assets where you've got the highest quality tenants, where their future prospects look the best. And so you will unfortunately get this kind of flight to quality, which wants
actually
good quality data to define that. So
yeah, and I think actually the sharp people would use this tool potentially to the complete opposite of what you're talking about. Say, well, if there's a solid asset somewhere with some weak tenants, is there something that we can do with some better proactive asset management and actually increase the value significantly by having a better, because clearly the income risk. And I think that, you know, that's what we see with a lot of the REITs, is this ability to do proactive asset management to improve that. So you might deliberately be buying assets which have a very high, you know, risk exposure, but actually with a bit of work and getting the right tenants in, you can really turn that around as an investment to you know, whoever in the market's looking to have that steady income, and you've made quite a good win on the upside.
Indeed,
as you've taken it.
As you say, an asset that's arguably mispriced, but with a huge potential in terms of, you know, the market rents you could achieve with different tenants. Well, I guess my last question probably requires you to get your sort of your crystal ball out. But you know, what do you see as both next for income analytics and the sector generally, and the use of data? Because obviously I think we're very much at the beginning of a journey for the commercial real estate sector in terms of automation and the use of big data, and perhaps a quite significant step change in the way we're able to share and access data and use it to drive decisions.
Yeah, so I mean, obviously, selfishly, I'd say that we're very keen that it's maximum exposure in our sort of scoring system, which is called the INCAN scores. It sort of becomes part of the investment committee and valuation process, you know, across the world. It's, as you've seen, it's very straightforward. It's a quant-driven model. It's based on data, so it's very solid in terms of analysing that. And I think that that ability to roll it out and provide it sort of globally is key. And part of that is we've got a distribution deal with MSCI, and we've got some others sort of in train to actually help these investors get access to it as part of, because of course it's just part of a much wider thing that they're analysing, and we recognise that. But we think that if we're able to get in there and provide to the likes of MSCI clients this additional income risk analysis, which is live to market, then actually there's a massive opportunity for the market to really understand, quantify that risk and react accordingly. And I think most importantly for the industry, it's about attracting more investment. And the more transparent we are, because obviously it's not regulated as yet, and the more we can behave like a regulated sector, the more likely people will invest in it.
Indeed, no, I think that's a very good point to end on, because I think we do need this transparency and to increase the trust in the sector, to make sure that people can invest with confidence and know they can monitor those portfolios moving forward. Well, it's been fascinating to chat, Matthew, and I look forward to a subsequent conversation to see how things are progressing. But it does feel like we're on the cusp of some really exciting progress here with data on commercial real estate. So thanks for your time. It's been great to talk to you again.
Great. Well, thank you. Thank you for your interest, and thank you for your questions.
Pleasure.